When you look back on 2019, it's going to be a watershed year for property, a year of two halves. At the beginning of the year, everyone was very nervous about the future of our property markets. At the end of the year, there's a lot more optimism, even though, of course, there are still some economic issues and some headwinds ahead for our property markets. But we've recently conducted our annual Property Investor Sentiment Survey. So today I want to share with you what 1,800 property investors are planning to do for 2020. It'll help you understand where you fit in with a wide range of other Australian investors, as well as giving you a glimpse at what's ahead, because really investors are going to move our property markets. Today's show is going to be a bit longer as I have a chat with Sarah Megginson, editor of Your Investment Property magazine, but lots of great tips. It was a fantastic chat I had with her. I just had that before I recorded this introduction, so I know that she's going to deliver some gold. So welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the fifth time he's won a similar award in the last 7 years.
Are you wondering what's ahead for property in 2020? Maybe you'd like to know what other Australian property investors plan to do. Well, that's exactly what we're going to discuss in today's show as we unpack the results of this year's Property Investment Sentiment Survey. And you're going to hear what around 1,800 Australians feel about our current real estate markets and what they plan to do next year. You see, the people we're going to talk about took part in this year's Property Investor Sentiment Survey that was run by my Property Update newsletter in conjunction with Your Investment Property magazine and onthehouse.com.au. So to discuss the results of this survey today, I'm joined by Sarah Megginson, editor of Your Investment Property magazine. Hello, Sarah.
Hi, Michael. Thank you for having me.
Well, we've been running this survey together for a number of years now, and it's now proven to be Australia's longest running survey because I started conducting this in 2011, and it's clearly the largest survey of Australian property investor sentiment. And in my mind, it showcases insights from a wide range of investors and would-be investors, because not everyone owned an investment property. And so it's got lots of vibrant insights on how consumers are feeling about property, how they're feeling about the markets, what the interest rate environments are doing to them. So let's have a look at it. But before we dig into it, Sarah, I know you've had a chance to look at the results. You've chosen some winners of prizes for people who've given their time to enter their feelings in the survey. What insights did you get from it? Was there any change in trends that you noticed?
Well, yes, absolutely. And it's very interesting now that, as you said, we're building up quite a few years of doing this, so we can compare the results from this year to previous years. And that, to me, is one of the most interesting aspects of it, to look at how sentiment is changing over time. The interesting thing you find is that some things actually don't change. One of the things that jumped out to me is in the last 3 years, we've had wildly different markets. So many things have changed. The investing landscape and the property landscape from 2017 to now is so completely different. But if you look across that period in our results, the kind of number one strategy for all investors was investing for long-term growth.
Now, isn't that interesting? Because you shouldn't change your strategy because of short-term things. Now, I think we should start off with a bit of a disclaimer. In general, I think we have an already reasonably educated audience. The majority of the respondents were subscribers to Your Investment Property magazine or to my Property Update, and on that basis, they are already a bit more educated than the general public on investing. But it was good to see that they didn't flip-flop as the market changed.
Which is, I think, one of the biggest challenges. It's really hard when, you own property in a market where the headlines are screaming at you every day that property prices are tanking and, the sky is falling. It can be really hard to stay the course and not panic. I know certainly in the last year or so, the readers have been contacting us with, I need advice. What should I do? Do I sell this? What should I do about this? What direction should I go and where should I buy next? So having a long-term strategy and staying with that through difficult times is so crucial. And I know certainly for me, I've been at Your Investment Property magazine since it launched in 2007. And absolutely, by a long shot, the people who have been most successful are those ones that just kept going and didn't panic and didn't sell at a stressful time. So I found that really interesting, that investing for long-term capital growth remains the number one kind of strategy for investors. But also the second most popular was to buy, add value, and hold. So it shows that people still see the value in holding and having this long-term view for their property portfolios.
That's good. Now, again, you've got to choose the right strategy. So we'll dig in and see, because people had different strategies. But I think your point's a good one. Don't make 30-year decisions based on the last 30 minutes of news. But it's so hard to do. But isn't it interesting how the news today is so different from the news when we conducted this survey last year, Sarah?
Oh, my goodness. And I mean, that I think the last few years they feel like they have been the most volatile. But then as I'm saying that, I remember, 10 years ago, we were just coming off the back of the GFC, and that felt extremely volatile. Our interest rates were more than double what they are now. And I think every period has its volatility, it has its changes. Even if we had done this survey 6 months ago, I think we would have got wildly different results, because 6 months ago we were in the middle of a federal election and so much was up in the air. So this year in particular has just been such a roller coaster. And I think what I love is that investors are really thoughtful. They're really thoughtful and really thinking about digging deep and thinking about what their strategy is, what they want out of property. The property is no longer this set and forget, any property you own, you'll do well eventually. That's kind of no longer the case. You really do have to be strategic to make a good profit in property.
100% right. Again, we're speaking to the converted, because the listeners of your podcast and mine and the subscribers to our publications already know that. Unfortunately, there's a whole group of Australians who buy on emotion. They buy close to where they live, where they want to holiday, where they want to retire. And they're the ones that tend to get into trouble, while those who think strategically and long-term tend to do much better. Now, any other insights before we dig into the results?
Yes, another thing that I picked up was the trend around rent vesting. And, honestly, I don't think rent vesting is anything new. I did it, probably 12, 13 years ago when I bought one of my first properties, and I lived in Sydney at the time and couldn't afford Sydney. I wish I could have. I'd be in a much better position now, but couldn't afford Sydney. So I bought a house on the Gold Coast, which is where I was from. And I actually bought it because I planned to move into it one day, but that never ended up happening. It became an investment property. I think this idea of rent vesting has kind of been around for a while, but in the last few years, we've really formalized it as a strategy. And I think people are more strategic about it. People used to do what I did, which is, I want to live there one day, so I'll buy that and rent it out and I'll go and live in another city for work or whatever it may be. Now people are very strategically looking at their situation and going, well, I want to live in this city and I can't afford it, but this is how much I can borrow. So where can I invest that for the best return? Out of our results here, we had 16% of respondents were rent investors this year, and almost half of respondents said that they would consider using it as a strategy to get into the market. So I think there's a really kind of big appetite, or there's this openness to looking at different ways to get into the property market.
As you say, it's not new, but now it's been formalised in some ways. I think another big trend I picked was that the majority of people remain positive. But of course they are, because the news is so positive now compared to if we would have conducted this, as you said, in the first half of the year. It really is a tale of two times of the year. Currently, 68% of people said they were looking to buy an investment property, up from this time last year, which was just over half. And you can understand why, because things were a bit shaky last year, and even more than in 2017. Interestingly, though, the number of respondents planning to buy a new home has remained consistent. It's been much the same over the last couple of years, 19% this year, 19% last year. It was down from 23% in 2018. But that doesn't actually surprise me, Sarah, because the decision to buy a home doesn't depend as much upon the market as, I guess, your family circumstances.
Absolutely. And your kind of stage of life, whether if you're in your early 20s, you might be traveling a lot, you might not be ready to kind of settle down into one spot. I think there are so many things that impact a decision to buy a home outside of property markets, and kind of the things that influence us as investors are more external. The things that influence us as home buyers are more to do with our personal situation and where we are in life. So I think they're totally different kind of trends. Always interesting to note, though.
Well, let's go through the questions one by one. And while it may take a little while, I think what's more important than the answers is your and my understanding of what the message behind them are. So I'll let you start asking the questions, and we'll see where we head.
Sure. The first question is always one of the most interesting to me because it's a very quick snapshot of how many properties you own. And this figure can kind of change over the years, and I guess it depends on who responds. We could get a larger amount of people that have bigger portfolios respond. So I think just because the results change doesn't mean that necessarily that reflects a broader trend. I think this really depends on who is replying. But this year we did get a large number of people who do own big portfolios. So those that own 5 or more portfolios was still quite a big proportion of the respondents.
Sure. So 22% owned one property, only 11% didn't own an investment property. But if you ask the general population, there'd be 2.1 million Australians who owned a property, and the vast majority of Australians who don't. So we're already speaking to an audience who's interested in property. So 22% owned 1, 21% owned 2, 15% owned 3, and then understandably the number of people who own investment properties dropped off. But there was 4% who owned 10 or more properties, and that shows that it is still possible. What we can't say is how long they've been in the market, when they started, but property is a long-term game, and you can't buy 10 properties in 10 minutes like some of the emails I get in my inbox say. I think really what you've got to do is play the long game, Sarah.
Absolutely. And I think the really interesting thing you just pointed out then is really with these results, 11% don't yet own a property. So that's kind of 1 in 10 out of our respondents don't own a property, when the general trend around Australia is that 1 in 10 do. There's 2 million landlords in Australia out of 25 million. So that just, I guess, goes to show you that this is, as you said, that the respondents to this survey are already property aware, educated. They understand what property can do for them. So it's kind of a bit of a different market than just general Australians.
Now, when we asked them where their investment properties were located, it was similar to last year, but interestingly, slightly more this year owned properties in regional Australia. So just over a third owned them in regional Australia, just about a third owned them in Brisbane, 27% in Melbourne, 26% in Sydney, and then it dropped off after that. 1% owned property investments in Darwin. So when we talk regional Australia taking up a third, there are so many individual markets within regional Australia. So if you look at it individually, I guess more people are investing in the capital cities, Sarah.
Yeah, absolutely. And I think, like you said, it is hard to know what regional means, because there's a very big difference between where I live on the Gold Coast, which is technically a regional market with over 600,000 people and right near a big capital city, and a town of Burke out the back of central Queensland where there's 2,000 people and not much going on. So regional encaptures such a massive, broad cross-section of Australia. So it'd be really interesting to know what that actual breakdown there is of who owns an investment in a really well-performing, good regional location with lots of economic drivers, lots of different industries, growing population, good employment, versus who has a bit of a dud investment in a regional area that's not going anywhere. That's something I would love to dig into. But I was interested too that so many people own in Brisbane. 33% owned a property in Brisbane. So that's kind of 1 in 3 of the respondents have a Queensland investment. So it was a little bit different to what I expected.
Disproportionate, isn't it? Interestingly, when we asked the questions last year where you think the best place to invest was, they thought Brisbane was the best place to invest in 2019. And we're not going to give it away just yet, but as we go in a little bit later into the podcast, we'll see where people think the best place to invest is in 2020. Now, we asked people, This is a question you wanted to know, Sarah. I remember you actually said, can we please put this in the survey? If you don't own an investment property yet, how long have you been looking, investing, researching, doing your homework? And 85% of people, as we already know, do own an investment property. But interestingly, quite a few people were looking, doing their homework, researching for a long time. I wonder whether they're waiting for things to be just right, to be perfect, Sarah.
And unfortunately, they will be waiting forever because there is no such thing as perfect time to buy. And you're right, I did ask for this question to be entered because I find a lot of the investors that contact us and a lot of the readers that contact us have analysis paralysis, where they do so much research, so much self-education. They go to so many, programs and seminars, and they buy the books and they buy the magazine, and they are just never quite ready to pull the trigger. And I wanted to find out what kind of percentage of people are struggling with this. Because for me, as the editor of the magazine, I want to be able to create really good educational content that helps them pull the trigger and take action, because you're never going to get anywhere if you think about buying. You have to take action eventually one day. So 4% of respondents said they spend more than 2 years planning and researching how they're going to get into the market. And that's a long time. That's a lot of wasted time that you're not in the market. 3% said they wait 0 to 6 months. 3% said they wait 1 to 2 years. 1% said they're not interested in investing yet, which is, I think, really good for people to know too. It's so good to have clarity about what you want to do. You might be really interested in educating yourself about property, but know that that's not something you're going to do for a number of years. But it's still really good to, kind of follow the market and watch what's going on now, so that by the time you're ready, you're actually ready to take action.
Makes sense. Now, we already spoke about the concept of rent vesting, which was the next couple of questions, and we found that 17% of respondents were rent vestors, but a large percentage said that they would consider rent vesting. About half said they would consider it if they needed to get into the market. Then we asked a question about what your preferred investment strategy, and there was a number of options, and interestingly, and pleasingly for me, the majority, 49%, said long-term capital growth. 16% were still investing for cash flow. And as you said a bit earlier, a lot of people did like, a fifth of them, 20%, the concept of buying at value and holding in the long term. Unfortunately, Sarah, there was 4% who didn't have a strategy and 2% who invested for tax benefits. Not having a strategy, that's a pity, but educate yourself. Investing for tax benefits, Sarah, that's a no-no.
Absolutely. Investing for the tax benefits that you're going to get from it is it's taking 2 steps back and then 1 step forward. That to me is the same as not having a strategy, because it doesn't explain why you're buying, the type of property you're buying, where you're buying it. I think in this day and age, people who have that strategy are probably looking at newer properties just so they can get better depreciation. But that could see them buy into a really oversupplied area, or buy an apartment in an area that, where you're going to have very little growth. So investing for tax benefits only is something I would definitely highly recommend you don't do. But the other statistic that I found really interesting here, we asked how many people have this strategy of buying, adding value and selling, and only 5% of respondents said yes to that. And what I find so interesting about that is that when I started investing 15 years ago, that was actually a really good way to make money. It's how I got started. I lived in far north Queensland, and I used to buy apartments really cheap, renovate them very quickly and cosmetically, and sell them, and make a very quick kind of $25,000, $30,000 off each one. And you do that enough times and you can build a decent kind of profit. But now that is virtually impossible to do, because the entry and exit costs are so high. By the time you have the stamp duty on the way in and the real estate commission on the way out, and then you pay capital gains tax on your profit, plus the cost of your renovation, buy, add value and sell is a really hard strategy to pull off these days. So I find that interesting, that I think the survey results reflected how difficult that is now. I think if we were to have this survey 15 years ago, that figure would have been much, much higher.
Well, of course, it depends what you do with the renovation. So structural renovations, adding rooms, adding en suites can make a significant enough difference to overcome those hurdles of stamp duty and selling costs and holding costs. The trouble is they take longer to do. They require development approvals. So to me, it's actually building and developing as opposed to really renovations.
I think it's a more advanced strategy now, and those who know how to do it and have the skills to owner builders, people that have the skills to renovate themselves, can do really well out of it. But I think 5% is probably a bang on figure there. It's for a very small percent of the population, whereas it used to be something that almost anyone could have a crack at that and do okay. That's not the case anymore.
Now, the one that I always am interested in, and the numbers stay much the same each year, is what percentage of people are negatively geared or positively geared or neutrally geared? Because there's always this story about ugly, greedy property investors who are rorting the tax system because they take advantage of the negative gearing benefits. But they're just business owners, mums and dads like you and me, who are trying to secure their financial future. So only 33% of the respondents were negatively geared. 36% had positive cash flow. And 21% were neutrally geared. In other words, their expenses were much the same as their income. Not surprised that 8% said they weren't sure, because we know that many investors just don't treat their properties like a business. So they're not really au fait with what's happening to their cash flow, Sarah.
Yes, which is, a little bit of a dangerous position to be in. And obviously negative gearing has been a huge kind of issue this year when Labor suggested the idea of tinkering with it. I've never seen the forum on our website have more activity than it did around that time. And I have to moderate the comments. And sometimes I had quite busy mornings where people had gone on a rant overnight and I was trying to delete defamatory things because people do get really, really passionate about this. And I think there is such a misunderstanding if you're not a landlord, or if you kind of don't look into it, if you just get persuaded by the headlines. There is that massive misperception that negative gearing is giving landlords these massive, massive deductions and it's ruining the property market. And the reality is that negative gearing, to begin with, is available on any investment. So it's not just properties, it's on shares.
And businesses too, Sarah.
It's on a range of different investments. And people forget the reason it's there. The reason why the government introduced negative gearing was to encourage people to buy houses, to give accommodation to people. If we got rid of negative gearing and we got rid of landlords, the amount of available property for people to rent would shrink considerably. And then the government would have to come up with more accommodation. So the government gave this kind of tax deduction as an incentive to say, go out and house the people so that we don't have to do it all ourselves.
Well, that's right, Sarah, because in Australia, we, as property investors, do it. Overseas, governments do it. You go to the UK and there are whole estates of public housing. So we've chosen in Australia to do it like with the education system. There are private schools, there's public schools, private hospitals, public hospitals, and much the same with public housing. Some of us help the government to do it.
Absolutely. And I think there's this misconception that negative gearing is massive, and it generally amounts to a few $1,000s per property, that you're going to get back. Some landlords who obviously have a lot of properties or have more expensive properties may be getting more benefits than that, but they're not. It's not this big bad ogre that people think it is. And then interestingly, when you look at our survey results, which is this curation of people who are really engaged and in the market, 90% of our respondents, or 80, I think 85% of them have property. Only 1/3 of them are using negative gearing. So it's not this big bad ogre that I think people have this misconception of it as being.
Sure. One more thought on it, of course. Negative gearing isn't an investment strategy. People seem to think it is sometimes. No, it's just the way you finance your property at a particular period of time. And the fact that a lot of the investors in our survey had substantial property portfolios would suggest they've had them for a while. And it's quite likely that they started off negatively geared, because when you start off, you borrow as much as you can to get into the market. But over time, you slowly either pay down the debt or the loan to value ratio drops as the value of your property increases. So it's just a point in time and the way you're funding it as opposed to an investment strategy. Now, not surprisingly, the next couple of questions were much more positive than previous years. 68% of investors thought it was a good time to invest. Interestingly, 20% were unsure, and 11% said, no, it's not a good time to invest. I don't know what they're missing, Sarah, because this is the best counter-cyclical opportunity in Melbourne and Sydney for a long time. And in Brisbane, Canberra, Hobart, the markets are still doing quite nicely. And when you ask them further, are they planning to invest in property next year? 42% said yes, 21% weren't sure, and 36% said no. And I guess it's not no because they didn't think it was a good time. I mean, you can't buy a property every year, can you, Sarah?
Yeah, and perhaps they bought one last year. I mean, the thing that I noted with this result is, do you think now is a good time to invest in property? This year we had 68% say yes. Last year we had 52% say yes. So kind of in 12 months, that's jumped up a fair chunk. But the people that said no, they don't think this is a good time to invest, that's also changed quite a bit. This year we only had 11% saying no. Last year we had 24%, so a quarter of the market thought that it was not a good time to invest. I think this really goes back to what we were saying before about having a long-term strategy and knowing what you want out of this, not just this year or next year or even in the next 5 years, but where do you want to be long-term? That's your game plan. It's not about even getting growth in the next year. I mean, that's great if you can, and if that suits your strategy and you want to use that growth to leverage into another property, then that's really important. But the more important factor is where do you want to be in 10, 15, 20 years from now? Because that's ultimately what should drive your decisions, not these short-term influences, which can change, as we've seen this year. Things can change on a dime. You can have an election, you can have APRA make decisions, you can have banks make decisions, interest rates can increase and decrease, and so many things can happen that are out of our control. And if we change our kind of our strategy or our plans or what we think we want to do based on those short-term external forces, investing is going to be no fun for you. You're going to be a nervous wreck all the time, and you're probably not going to get great results.
So we asked then, what type of property would you like to buy? And not surprisingly, Sarah, apartments were only 7%. At the moment, there's a lot of negative news about apartments, especially the new ones, the high-rise ones, the ones with structural problems. And apartments haven't performed as well as houses. So 41% of people wanted to buy a house. 31% like the concept of buying a property with adding value and renovating or developing, which goes back to their initial strategy also. And again, the majority of people were wanting established properties. Only 6% were talking about new. And I'm really pleased to see that only 2% of people suggested off the plan, Sarah. That's, at the moment, an area I'd be very cautious about investing in.
Oh, 100%. This year has been really difficult. It's still unfolding with that Opal Towers in Sydney. That's just kind of a disaster that I don't even know where you start to unpack that. I really feel for everyone involved in that. But as well as that, there are so many markets that are oversupplied with units at the moment. I think, some people are making a profit out of it, but you have to really, really know what you're doing. And I wouldn't be investing in an apartment without really clear strategic advice from someone who really can guide you in the right direction there, because it can go wrong a little bit too quickly for my liking.
Now, it depends where, of course, Sarah, doesn't it? So in Brisbane, more people like living in houses. But if you gave me an apartment at Bondi with beautiful views over the water, where everyone else lives in apartments as well, it's an established, and it's an Art Deco building with some character and scarcity, that would work. So it depends where.
Somewhere like Bondi, where it's landlocked, you can't build a substantial, and we can't flood that area with heaps of new stock. So that it really comes back to supply and demand again, and that's where sometimes apartment investors get caught out, because they buy in a giant complex of 500 units where there's no scarcity factor, like you were saying, there's no unique factor, no scarcity factor, and so they're just this cookie cutter replication of each other, and there's no growth drivers there. So that can be a little bit risky.
Of course, the next question was important also. Where do you expect the best capital growth to be over the next 5 years? And when we asked this question 12 months ago, Brisbane was the winner, and everybody expected Brisbane to be the strongest performing market. And Brisbane did do well. It didn't grow as strongly as some people expected, but it didn't have the falls of Sydney and Melbourne. But this time around, 39% of our respondents thought Melbourne was going to be the best long-term capital growth. We're talking about 5 years. Brisbane, 37%, Sydney, 33%, and only 19% were talking about regional Australia. A small percentage were talking about the Gold Coast, Perth, Canberra, Hobart. Hobart seems to have had its run. And interestingly, 21 people thought Darwin was going to do well. Not sure about that, Sarah.
They're very optimistic people. They probably hold property there, and it's hope more than anything.
That's right. So, what sort of property do you think would be making the best investment over the next 5 years? And again, 1% said off the plan inner city apartments, 2% said apartments. So, in general, it was a house, a detached house on an inner or middle ring capital city suburb, or a property with development potential, value add potential. 11% still said a house in the outer suburban growth corridors. Sarah, in my mind, they're not the areas where you're going to get as much capital growth, because the abundance of supply is the enemy of capital growth. So they are growth corridors, population growth, but not necessarily capital growth.
Yeah, and that comes back to what I was saying before. If you've got an area like Bondi that's surrounded by water, there's only so much you can do. The land that you've got is finite, and there's a reason why, for instance, in Sydney, the eastern suburbs just continue to go up in value, because it's a beautiful premium area. You're right on the beach, and there's no more land. In these kind of outer suburban areas, there's this endless supply of land, and when you have so much land, that means there's no supply and demand driver that's going to push prices up. So even though on paper it looks like you're getting all of these great things happening, infrastructure and population growth and all of these good things, there's no limit on supply. So that the growth is just not going to be there the way it will be in other more inner city, inner ring areas.
Sarah, the other factor that is not a judge of people, but it's a fact of the demographics of the people there. Often they're not the higher wage earning people. They're more in blue collar areas or young families who've taken on the commitment of a mortgage, and they're at their maximum capacity of borrowing. So there's little opportunity for increasing capital growth in the areas there, because the people in those areas are the ones who are currently having trouble because they're not getting much wages growth. So I like investing in areas where people have got higher disposable income and they can afford to and are prepared to pay a premium to live in those sort of areas. So I think we're saying much the same thing. Now, why are people investing in property? Always interesting to know, and not surprising. For better lifestyle choices for themselves and their family, 43%. Self-funded retirees, 41%. Now, these add up to more than 100% because people were able to tick more than one, to retire early and have more choices, to supplement the superannuation, to leave a legacy, which is what I'm doing for my children and grandchildren. Can't see the government looking after me. 22% said that. That doesn't surprise me, Sarah.
No, not at all. The pension is not, it's not a great fallback option these days. And what I really love about these answers, and I guess something that I encourage our readers to do whenever we're putting stories together about building wealth within the magazine, is to really focus not on the word retirement or the concept of retirement, but on the concept of choice, because to me, that's what wealth and property is all about. It's about creating choice. I work in the media. I absolutely love my job. And if I have my way, I will be working until I'm 80 because I love it. I don't want to become wealthy and leave my career. I want to be able to become wealthy so that I have the choice to shape my life however I want to. That's what we try to help our readers see, and what the whole kind of purpose of investing to me is to help create these choices for people, so that I think when you put the word retirement around it, particularly people in their 20s and 30s, they just go, oh, that's forever away. I don't have to worry about it yet. But if you start thinking about it now in your 20s and 30s, you can build wealth over the next 30, 40 years in property that can set you up, and you can just have the ability to create the life you want without these financial burdens. If you are facing retirement on the pension, I don't think that's going to be a viable option in 20 to 30 years. I don't think we're going to be able to afford that anymore. So that figure of 22% who can't see the government looking after me, I think that's going to increase.
I agree with that. And of course, retirement in my mind is a middle class, a working class concept because all the successful people I know actually don't particularly want to retire. They just want to work at their pace, do what they want to do, when they want to do it, with whom they want to do it, and have choices. I've just had another birthday last weekend, Sarah, and I have got no plans of retiring, but I'm having fun. I'm having fun talking with you and doing these sort of things. So when we asked people what their end game is, they in general wanted to live off their rental income. Only 12% are now talking about living off equity, which is a strategy that I liked many years ago also. But in today's tighter finance environment, it's actually very, very difficult to do and almost impossible unless you have a big enough property portfolio. 23% of people are saying, well, I've still got to maybe sell some down and live off the rest of them. 18% said hold and never sell. So I think people are being realistic that they realise they've got to get the capital growth initially. The first stage is to get asset growth, and then they move on to live off the rental properties. The next question, always interesting, Sarah. Are you planning to buy a new home? And this year, 20% said yes. It's really much the same as previous years, Sarah.
Yeah, it is. And this kind of comes back to what we were talking about before. Planning to buy a home versus planning to buy an investment property are two totally different things. So I think this is always an interesting kind of stat. It explains, I guess, where people are outside of headlines and market cycles and things like that, because your intention to buy a home, that could be related to, I got a new job in a new city, so we have to move and I'd like to buy a new home there. Or, there's so many different drivers for this. So I think it's always interesting to kind of see what people are thinking in this area.
Well, the next two questions went hand in hand. Have the tighter lending conditions, the banking lending conditions, impacted on your ability to purchase another property? And what's your biggest stumbling block going to be? And 42% of people said that the current lending conditions are restricting them. And 26% for the next question said it's actually loan serviceability. So with the lower interest rates, despite the lower interest rates, it's still the bank's tighter lending serviceability criteria that's creating a problem. And of course, 15% just haven't got enough deposit. And that's a hard thing when you first get into the market, saving for your deposit, Sarah.
Yeah, it is, especially these days. I think when I started investing 15 years ago, my first property deposit was something like $13,000 because you could get 95% loans back then and property prices were a lot lower. So that barrier to saving, I think I sold my car and I saved about $8,000 and that got me into my first property. So it's obviously a very different proposition now. I can understand why saving the deposit is such a big hurdle. The interesting thing in this result here is that 25% of respondents said I don't have a major obstacle. So that's 25% who are kind of in the box seat and ready to take action, which is amazing. That's up. Last year it was only 19%. So it went from 1 in 5 last year to 1 in 4 this year. Let's hope next year it's up to 1 in 3.
Well, let's hope they take advantage of it. Now, you said you needed, what was it, an $8,000 deposit?
I needed about 13,000, I think. So I
13.
sold my car for
Okay.
$5,000 and I saved the other 8.
Well, when I invested, we needed a 2,000 deposit, my first one, and I actually didn't have that. So I went halves with my parents. I managed to have 1,000, but remember, that was way back in 1973. And we took a 30-year mortgage. We paid $18,000, put $2,000 down, so took a 30-year mortgage for $16,000 and had no idea how we were going to repay it. Sarah, I got $12 a week rent and I was excited.
Wow. Oh, do you know what I love about that story, though, is that we now look at that and we're kind of laughing at those figures. But now, my kids are 3, 6, and 9, and in 30 years from now, they're going to be saying, remember when you could buy a property for under $1 million, or remember when you were only getting $500 a week rent, and now the average rent in Australia is $2,000 a week, or whatever it's going to be. The best time to make a decision is when you look back and go, I wish I had done that then.
The family car then was the Holden Kingswood. Remember the Kingswood? That was $2,000. But my big mistake was I actually sold it when I got married. I didn't understand I could refinance it. Maybe I wasn't able to. I can't remember back in those days. So I sold it for my half share of $32,000. It had gone up a lot. It's back to my parents. Pam and I bought it off my parents or my mother in the early 2000s. So I actually still own the first property. Since then, I've built 2 townhouses on it. $18,000 then, well over $2 million today, Sarah. So that's the power of compounding, but over a long, long period of time. Next question was, do you think it's a good time to fix interest rates? And people are a little bit confused. 50% said no, 30% said yes, 19% uncertain. We are at historic low interest rates, and I can't see them going up for a while. I've actually had to make that decision only this week as part of our loan facilities came off a fixed rate facility, and boy, has my interest rate dropped because I fixed 3 years ago thinking it was at the low point then. So, Sarah, I can tell you how to decide whether it's the right time to fix or not. If Michael Yardney fixes, it's the wrong thing to do because every time I do, the market goes against me. So maybe there's...
I have had similar experiences. I think when you do choose to fix interest rates, though, it has to be a decision less about the money. You're never going to beat the bank. So any time that I have fixed, it has been for peace of mind. I actually fixed one of my loans in January or February this year for 3.9% because at the time I thought that is, exceptional. I've never had a loan this low. I'm going to lock that in for 3 years. And now with that same bank, I have another variable loan with that same bank, and I just got a letter yesterday saying, oh, we've reduced your rate again. You're now down to 3.3%. And disappointing, but I made the decision I made. It was the best decision for me with the information I had at the time. So you just kind of have to suck it up when those things happen and look forward to it coming off the fixed rate and getting that nice reduction.
100%. That's a very important lesson. So I don't try and fix the bank. Fortunately, I'm in the position to have a substantial level of debt, but I've got a great level of assets as well. So it's a debt management tool. It's a risk management tool. If I lock in, I know what's going to happen to my cash flow. So some of my debts are variable, some are fixed, and my fixed ones I've locked some at 1, some at 3, some at 5 years, so that they don't all fall due at the one time, so I don't get a big shock. At least I can do some planning because, again, I treat my properties as a business. Next question we asked was, well, what's going to happen to property in 2020? And it has changed so much from 12 months ago, but again, not surprising. So 43% of people saw an increase of properties overall, because there's not one property market in Australia. So it's a hard question to answer, but they thought 43% thought that it probably should go up 0 to 5%. And 18% thought it'd go 5 to 10%. So the majority of people are seeing strong property growth this year, very different to 12 months ago. And it's interesting, there's lots of predictions of what's going to happen next year. We'll be reporting it. You'll be reporting it in your investment property magazine on a regular basis, and so will I. Always like to ask people, what are you going to do? Who are you going to ask for advice? And my concern is, Sarah, 32% of people said they're not going to ask anybody for investment advice moving forward. Sarah, the problem in my mind is that there's 25 million property experts in Australia. Everyone thinks they're an expert because they've lived in a home, they've rented something, they've bought something in the past. But if you want to outperform the average property investor, if you want to get past that 1 or 2 properties, I think you should be asking somebody for advice, but you've got to be careful who you ask, Sarah.
Yes, absolutely. And, you only need to have one bad experience with property to then become very down on it. And I have met my fair share of people at barbecues when they ask, what do you do? And I say, I'm a real estate and finance journalist. And it's like saying you're a used car salesman. The air gets sucked out of the room and they're like, property, why would you ever do that? I lost so much money and da-da-da-da. Who you get your advice from can shape your financial future. And advice it can come very subtly in the form of well-meaning friends and family that don't know what they're talking about, who encourage you in a certain direction that, that can lead you down the wrong path. So if you are one of those people who has ticked no one and you're not planning to see an actual advisor or a property strategist, I would just urge you to be really careful about where you get your information and who you listen to, who you surround yourself with, because it's just so easy to get persuaded by people. And this is something I take quite seriously at the magazine, because we get inundated with data and press releases every day from lots of different people who have lots of different agendas. And so it's important to me that we don't report on things that are going to impact people in a negative way. what I mean by that is, you can see these headlines that pop up saying property prices to drop 40%. And then when you actually read the story, it's one so-called expert or one, economist, and he might even be from overseas commenting on Australia saying, oh no, it's going to happen like America. The bottom's going to fall out of the market. And I think that kind of reporting can be a bit reckless. So we try to, as much as we can, we try to report in a balanced way so that people are just getting the information and they can analyze it and interpret it in their own way and not be persuaded too much by other people with, their own agenda.
Well, 19% of people said they were going to speak to a property strategist or advisor, and that's great. When I started, there was no such thing. And when you started 15 years ago, there were very few people in that position. 6% said they were going to speak to a buyer's agent, and I'd be a little bit cautious about that. Now, I've got to give a disclaimer. Metropola, one of Australia's largest buyer's agencies, and buyer's agents have a role. Their job is to fulfill an order. But if you ask somebody, if you live in Perth and you ask a local Perth buyer's agent, where should you invest? They're not going to say invest in the East Coast where the capital city markets are going to outperform. So I believe you do need an advisor, and nothing wrong with having, more than nothing wrong, you probably should have a buyer's agent on your side as well. I think you need a more holistic approach. And even though some people are going to ask their accountant or their financial planner or their mortgage broker, while the accountant would be very good with tax and the mortgage broker will help you through the maze of finance, they're not always in the right position. They're rarely actually in the right position to give you property advice. So ask the right people.
That's exactly right.
And again, 1% we're going to ask their property manager. I'd again be careful who you listen to. Now, when we asked a bit of some personal details, interestingly, 74% of our respondents were males. I found this every year. It's always the same. Even though the readership is much more balanced, I don't know. Maybe the males are doing it because their wives told them, Sarah.
I'm not quite sure. I know definitely our readership at Your Investment Property magazine is much more balanced. We have, a really high proportion of female readers. So I'm not sure why we have a larger uptake of male kind of respondents here, but it is an interesting stat, the same as the age group. A large majority of the ages of people responded to this were older, which again, I think is reflected in the answers. We have quite a lot of sophisticated answers here of people that own more properties or are quite thoughtful about their strategies. So, it's not too surprising that they're older. I think they're people who have perhaps been in the market a little bit longer. But always interesting to note the age demographics. It didn't change much from last year to this year. It was an older demographic last year as well. So that's what I love about having these surveys over the years. We can kind of compare and see how this is changing.
And they were also in a high income bracket. Now, we're going to, in the show notes, put a link to these results so you can get a better understanding of what the respondents said. So I'd like to say thank you to those 1,800 people who took the time and trouble to respond, because it helps us understand what's in their minds. It helps you decide what sort of content people want or need to help them move forward for Your Investment Property magazine and the sort of blogs I like writing for Property Update. Sarah, we were looking forward to a fantastic 2020. I think as we move into a new year, into a new decade, we're doing this with much more confidence than we did 12 months ago.
100%. I think definitely there's much more optimism in the air now than there was this time last year. And as always, I think it's just a really exciting time to be in property. It is always changing. The trends change constantly. And that's what I love about it. There's so much opportunity that abounds. And, I'm not saying this with rose-colored glasses. I've had my fair share of disappointments in property. I've had my losses. I've made poor decisions. But overall, what property has done for me and the choices it has given me in my life, I'm forever grateful for. And I absolutely love that I am in this position to run this magazine and help other people figure out how property can help them have a better life too. It's a real privilege and I love it.
Great. So I look forward to having further chats with you on my podcast and on your podcast as well. And in 12 months' time, we'll be getting back together again. No idea what the results are going to be. There's too many changes. Some things will remain the same. And I think the fact that we live in the best country in the world at the best time in history will be the same. I think we're going to be comfortably saying that property values are much better at the end of 2020 than they were at the beginning of the year. And in between then and now, there's going to be so many fun things to talk about and to write about together. Thanks for your time, Sarah.
Thanks so much, Michael.
Well, as I said at the beginning of the show, it was a bit longer today, but I hope you got some insights into the way other property investors think, and with the discussion Sarah and I had, a bit of insight about how successful property investors think. Now, if you got some benefit from today's show, I'd love you to help me in my quest to make as many investors more financially fluent. I'd love you to pass the show on to somebody. And if you do, I'd really appreciate it. And if you would like to tell the world, why not leave a review on iTunes or Stitcher or Google Play, wherever you listen to this. But if you want to share the show, there's a little share button on most podcast apps. We'll be giving you regular commentary twice a week on property market success, finance, money in the Michael Yardney podcast. And in between, keep contact with me on social media. More recently, I've been having fun on Instagram. I'd like to find out more about you. You can look up me at Michael Yardney at Instagram or Twitter or Facebook. I look forward to catching up with you again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?